everyone, and welcome FSC members and guests to today's Financial Services Council FSC Connect series. Today's session has a very fitting title, as we certainly have a panel of leading lawyers with an extensive depth of knowledge and experience across the wide range of topics we will be discussing today. We will be looking at what's in the pipeline for 2022, what issues our leading lawyers are experiencing from their client base, tips, suggestions, and compliance activity required to respond to the sea of legislative and regulatory change that our industry is facing. FSC provides a voice for the industry in responding to consultations and bills and policy advocacy. We hope today's session will complement this and will be educational, valuable, and informative on the current and upcoming changes. For this webinar, we encourage you to make use of the Q&A and chat function, and our panel will aim to answer questions as they arise on applicable topics, and we will also have time for questions at the end. Today's panel comprises Claire Evans, partner, Neave, Catriona Grover, partner, Dentons, Kensington, Swan, Lloyd Kavanagh, partner, MinterEllisonRuddWatts, and Sam Hiebendaal, senior associate, Gully. I will ask each of our panellists to briefly introduce themselves and their areas of practice before handing over to our MC, Kristina Kilner, Head of Regulatory Affairs, AIA, to facilitate our discussions. Let's start with you, Claire.
Oh, hi, everybody. I'm partner at national law firm Neave, and I head the corporate team along with leading the financial services team and act for a range of clients in the financial services sector.
Thank you, Claire. Catriona?
Thanks, Carissa. I'm Cat Grover. I'm a partner at Dentons, Kensington, Swan in the financial markets team and specialise mainly across investment funds, insurance and financial advisor arrangements.
Thank you, Cat. Lloyd?
Hi, I'm Lloyd Kavanagh. I lead MinterEllisonRuddWatts financial services practice. We help a wide range of clients from large banks, insurers and fund managers with their products, engagement with regulators and with innovation.
Thank you, Lloyd. And Sam?
Thanks, Carissa, and hi, everyone. I'm Sam Hiebendaal, a senior associate in the litigation department at Gully, and I've acted for a range of banks and insurers here and overseas in London, across three specialties really: insurance, class actions and competition law.
Thank you, Sam. Kristina, over to you.
Good morning, everyone. I'm Kristina Kilner. I'm the Head of Regulatory Affairs at AIA New Zealand. Thank you to everybody for joining us today for this Leading Lawyers webinar, a title which myself and the panellists will try to live up to in the next 60 minutes. A big thank you to Carissa and the Financial Services Council for hosting this event and keeping us all connected in these challenging times. It's greatly appreciated. As Carissa said, this session is dedicated to discussing the current regulatory environment and the consultation pipeline for 2022, as well as hopefully discussing some new compliance activity that's expected of our FSC membership. I encourage everyone, as Carissa has already mentioned, to use the chat function to input your burning questions. Carissa will be monitoring the chat function as we go, so she'll endeavour to try and get those questions asked at the time so that we can keep some robust debate going. So with that, just to briefly introduce the session and get us started, we all know that there's been some significant regulatory reform and engagement in the financial services sector over the last few years, and 2022 will be no exception. And in the midst of a tight labour market and an ongoing pandemic, regulatory and compliance teams may be grappling with which consultations to prioritise or what regulatory change projects should get what limited resources, or how to manage their regulatory relationships in this rapidly changing regulatory landscape. So hopefully we can send you away with some practical tips and responses to those sorts of issues. So Lloyd, I might pick on you first. We've heard earlier this week from the new FMA CEO, Samantha Barris, a very positive vision to, and this is a direct quote, work with industry to make sure people get the financial products and services they need when they need them, and they do what people reasonably expect them to do. So this is a great focus for the FMA, of course, and we wouldn't expect anything less. And there has been some great engagement with our regulators recently on some really key issues. But I just want to reflect back over the last couple of years. The Reserve Bank's established a separate enforcement team. The FMA has significantly increased its funding in that area. And the then FMA Acting General Counsel, Karen Chan, gave a speech late last year around the FMA's approach to supervision, regulation and enforcement. So what have been your observations on the regulators' intent to work collaboratively with the industry versus this increasing enforcement activity? What are you seeing in practice?
Thanks, Kristina. I think it's definitely right to characterise what we've seen over the last 3 or 4 years as a much more muscular approach from the regulators, particularly I'm thinking about FMA and Reserve Bank of New Zealand, but the Commerce Commission, for those who get to interact with them, will have seen the same. You're right to highlight Samantha's comments, which I thought that was a great address and a really good start from the new CEO at FMA, emphasising working with the industry, and also she really emphasised investor outcomes. But I didn't hear anything in that indicates a change from the strong approach that we've been seeing. And I guess behind that approach, I think there's a handful of reasons which haven't changed. So first of all, we have a whole series of regimes which are now reasonably seasoned. So the AML Act's been around for a while, the FMCA's been around for a while. And what regulators tend to do is at the beginning of a regime, they've typically kind of been open to helping the willing compliers get themselves together. But around 3, 4, 5 years after that's been in place, and it's kind of in those regulatory policy courses that get taught, they change to saying, hey guys, you've had a good opportunity. We now expect you to be relentlessly executing this. As well, we are still seeing the ripples crossing the ditch from Australia coming out of the Hayne Commission. And one of the things that maybe didn't get as much coverage as it might have in the media was that some of the Australian regulators were almost unindicted defendants and were heavily criticised in Australia for not being muscular enough in their engagement. And while the FMA has been very clear that it didn't adopt an ASIC type approach of why not litigate, it has influenced the thinking that they need to be seen to be taking action, not just taking action. And then lastly, as you've highlighted, there's been an additional commitment of resources coming from government, which means that they've got the resources to do that. I think for any of the members who are thinking about all of this, a good place to go back to, even though Karen Chen's moved on to the SFO, to that speech she gave in November last year, which you can find on the FMA's website, and which some of my colleagues in Minter's litigation team wrote some commentary on, and I contributed to. But there's some really good lessons out of that. First of all, a good relationship with the front end of the organisations is vital, but you can't rely on that to mean that you're going to get a free ride. So, and we've seen clients kind of sometimes struggle with this. They have a very good relationship with the front end person who comes for a visit, and then weeks later they get a letter asking some very aggressive questions and they're sort of surprised. Every engagement with a regulator should be taken seriously. You need to be sure of your ground and have done your due diligence. Another area has been when people are self-reporting things that haven't gone wrong. I mean, that's always a good idea to mitigate the impacts, but it's not a panacea. You should still expect that self-reporting, particularly if it's been prompted by a regulator review, but even if it hasn't, they will ask really hard questions. And the excuses that in the past, where there was a justification of, well, our system let us down, in the past might have meant people had a private warning. now the regulators are seeing those failures as potentially signs of a systemic lack of commitment of resources to getting it right. So I think the big thing that you have to do is proactively make sure that your approach and your systems and processes are right at the front end. And I think we're all seeing in the media over the last year lots of reports of formal warnings or directions being given where in the past perhaps the regulators would simply have said, okay, you brought this to us, fix it and don't make another error. So I think it's a very different world than we would have seen a couple of years ago.
Thanks, Lloyd. I might pass to Sam for any observations you've seen in the market.
Yeah, thanks, Kristina. Certainly agree with what Lloyd has said, and we'll just emphasise the importance of striking a balance when you're dealing with regulators between doing the prudent and sensible thing of self-reporting matters as they arise, but also just carefully calibrating the information that you're providing, the timing of providing that information. Always obviously better to raise a problem and then immediately say, here's the solution, rather than just saying, we've come across this issue, we don't know how many people it's affected, and we're going to try to do something about it at some undefined period in the future. So, as Lloyd says, this increasing move to a more, what Lloyd described as a muscular approach, really does put the onus on all of us as well, just to make sure we're carefully scoping our communications with the regulators, while maintaining that kind of transparent and proactive engagement, which is beneficial.
Thanks, Sam. There are times, I guess, when an issue is identified, which can be quite complex in terms of ring fencing it and understanding the full impact of the issue, both in terms of the systems and processes, but also the number of customers impacted. What is your advice between balancing the timeliness of your notification to a regulator that there is an issue versus being able to tell them, give them, the detail that they're going to want on what the issue is, what's the impact, and what you're going to do to resolve it?
Yeah, of course, horses for courses on the facts, but to try to give a more helpful answer, I think the regulators are generally pragmatic around things like that. They understand that we're dealing with complex businesses and complex systems, some of which are legacy systems which may not have the kind of current functionality of the new systems. And so provided we're able to explain there is an issue, it looks complex, we've been working hard on it, here's what we know so far, and here's what we're going to do to get to the point in time where we can tell you more about this. I think they are generally willing to engage on that basis and will understand that we're doing our best in the circumstances, and we've taken the responsible approach of proactively raising it with them at a suitable time.
I agree with what you're saying, Sam, but also a point you made a few minutes ago. They typically won't react well to just going to them and saying, we think we've got a bit of a problem, we don't know how big it is or what we're going to do about it, but we're just sharing. If you find an issue, it's important to work really fast to find out as much as you can and what you are planning to do about it, because it's always easier for the regulator if you can say to them, here's an issue that we've found and we are already defining the scope or planning to take this action to solve things, because as Samantha Barris pointed out, at the end it's all about the investors. So when you raise an issue, you put them on notice that there's a potential investor problem, and they just want to know how the investors are going to be taken care of.
Thanks, Lloyd. I just want to stay on this theme, but go to a slightly subtopic. And I'll go to you, Sam, again on this proactive enforcement theme. There are some proposals that have come out in recent times from our regulators proposing better and wider tools by virtue of the Reserve Bank Act review and the latest IPSA consultation. The IPSA consultation includes proposal to increase the RBNZ's powers to investigate insurers and take enforcement action, as well as manage insurers in distress. which I think we can all agree is probably warranted following the CBL liquidation. And a key element of that consultation is a new on-site inspection power. And it is possible that the FMA may also seek to adopt a similar power. What are your thoughts on the scope of that proposed power?
Thanks, Kristina. That's a good question. And I think the key question, what is this on-site inspection power going to look like? And some of the details are sketched out in the consultation paper, but we don't have a lot to go on at this stage. I suppose three things to highlight about what's been said. First, this new power is going to be used as part of the bank's kind of ordinary supervision rather than carrying out investigations. The bank says that where it's carrying out an investigation and it wants to do an on-site inspection is going to go through the current Section 130 route, which is inspections by consent or getting a search warrant. And I think that is an appropriate distinction to be made, but query how these things are going to play out in practice, particularly where, for example, you have an on-site inspection carried out for just a general supervisory process. And then if, unfortunately, the bank discovers something that it wants to investigate, or worst case, something that it's already investigating, there's going to be a real question as to how that information can be used and whether it's been gathered within the scope of the power. The other details that the bank has given is almost more in the nature of the practical matters of how the power is going to be exercised rather than any kind of legal scoping as to the limits on the power. So it says notice will usually be given in advance of an on-site inspection, but inspections without notice are also possible. So, I mean, giving notice in advance, of course, makes good sense, and I think it just reflects good practice for regulators here and overseas. And kind of in the environment we're now in, probably pretty crucial too if you've got most of your staff working from home and RBNZ comes and knocks on the door and there's no one to answer it. So pretty key to make sure there are actually going to be people on the site. I don't think they're planning to knock on people's doors at home. And then, yeah, one hopes. I'll be getting more calls if they do. And then also there's possibly going to be a specified minimum frequency for inspections. So perhaps one a year at a minimum, although calibrated around the risks presented by different insurers. So these are all matters on which the bank is consulting. And one thing I'd encourage all of our members to think about, and one thing that I always think about with my litigation hat on, how is this going to go wrong? What are the safeguards in place for the insurers when this power is being exercised? And of course, to be fair to the bank, the consultation says that there's going to be a limit. The power has to be exercised only at reasonable times, so not 2 a.m. site inspections. And as I mentioned, it needs to be for the purpose of supervision, and the staff carrying it out have to be appropriately qualified. But that's not enough, and the bank is asking what additional safeguards should be in place. And given part of the purpose of introducing this power is to harmonise the bank's powers across the different sectors that it regulates, I think we can look to the current on-site inspection power for AML issues. And there, at a minimum, that power allows people basically a privilege against self-incrimination, and it doesn't require anyone to give over privileged information to the bank. Because I think one of the crucial aspects of the on-site inspection power that isn't really discussed in the consultation paper, but which does appear in this AML power, is that this is a power essentially to force, if I can put it that way, the insurer or the insurer's staff to answer questions. They will be under a legal obligation to answer the bank's questions when the bank is on site making the inspection. So when you have that kind of compulsory power, there really do have to be safeguards put in place.
Absolutely, including making sure you've got the right staff member in the room, which can very easily happen. And I do wonder about the comparators to the AML program, because obviously that is designed to prevent crime. Whereas if the RBNZ is proposing to use this as a supervision tool and paired with the intention to work collaboratively with the industry and have open and collaborative type relationships, it does seem that those two are a little bit at odds with each other. So I agree with you. I think the safeguards are going to be absolutely crucial. in order to ensure that if this power is introduced, that it's used appropriately, it's used consistently across sectors, and that reasonable notice is given almost every time, but perhaps used as an exception where there is a worry that, the organisation may, remove evidence or what have you, which I would have thought would be very rare.
Yeah, exactly. And it's difficult to imagine a case in which the bank doesn't want to use its investigative powers, so the bank doesn't already suspect that there's a breach or will be a breach of the Act, but still feels the need to show up unannounced. But of course, we can't exclude that happening.
No, but hopefully used sparingly in those circumstances where they think that might be a risk. I might cross to Claire. Did you have any particular insights?
Yeah, I just thought, sort of reiterating what Lloyd was saying, there's definitely a maturing in the enforcement and the maturing of the regulatory, the regulator. And I thought also part of that, you can see their expectations are a lot higher. And so that, a lot of organisations with the raft of regulatory change trying to keep up with their expectations. And I think one thing would be is from the regulators is the continued guidance that they tend to put out is useful so that you can keep up with their expectations. And so while you've got enforcement as a tool, it's certainly not the one that anyone really ever wants to go down to, and so it can just be used at the last resort rather than the willing compliers.
I'm just going to jump in with a question that I've got that's come through on supervisory and enforcement. The question is, there seems to be a big gap in the FMA supervisory and enforcement teams in the sense of supervisory saying all is okay and enforcement then taking action nevertheless. Any advice on how to engage effectively with the enforcement team? And do you think the supervisory team will be more aligned in the future?
Sorry, Lloyd, go ahead.
Yeah, I mean, it's a very apposite question and a big one. I think I go back to the comment that I was making earlier is don't draw more comfort than you should from your friendly relationship with the front end. I think you have to approach all of the engagements making sure you're prepared and frankly that you are focused on the investors' best interests at all times and delivering good outcomes. But they do now consciously run those teams very separately to reduce the risk of enforcement in a regulator's sense being captured by the market.
Yeah, I agree. I think that split is by design. It allows the supervisory people to do their role within a kind of framework, and then if there are any issues, just to pass it along to the investigation enforcement department to deal with separately. And I think that highlights, I would say this as a litigator, but I think it highlights the importance of getting a disputes lawyer or someone who specialises in investigations on board early if you think that something has the potential to develop into an investigation.
I think I'd also add, Sam, though, the supervision or the front end of a regulator like the FMA itself has shifted its approach. So we've all seen warnings or directions come out of signed by people whose titles are definitely the front end of the organisation because they feel the same incentives, imperatives that I outlined earlier. So I think in everything you do, this is the time to be getting it right from the start rather than trying to play catch up when something goes wrong.
So from a practical standpoint then, say you've had a supervisory meeting with your relationship manager or what have you, and it's been a positive meeting, and then the following week or whenever it is, a notice comes in that may indicate that there's enforcement action, sort of highlighting the scenario that Carissa's referring to. Is the advice then that not to engage in conversations with your relationship manager on this and stick purely to communications with the enforcement team on this?
Yeah, again, horses for courses, but I think that will often be a suitable approach. It will in some way depend on how the regulator is themselves handling it. As I mentioned, a lot of the time we see the supervisory department has an issue and then they kind of reach an end of their process on it and they pass the matter over to enforcement. And there your key contact is just with enforcement. But it does highlight, I think, the need to be careful in your BAU conversations with the regulator if there is an investigation going on in the background. And your internal teams need to be very linked up to make sure that nothing you're saying is cutting across each other.
I think one thing particularly to be conscious of is even in everyday interactions, your teams need to be aware, need to take care to make sure what they say is accurate, because sometimes we've seen people in good faith and trying to be helpful say things with the benefit of actually some proper inquiry shows weren't actually the case. A problem wasn't actually the way it was initially characterised, and perhaps in fact was much more manageable. So you just need to be, it's certainly important to be super clear that whatever you're saying you can stand by and it's factually based, and that no one kind of overdresses things beyond issues beyond what they are.
No, I agree. And also perhaps even if there is a possibility for change, that it's clear that these are the facts as at today, and that the investigations are ongoing and could be subject to change. I want to pass it over to Catriona Grover. Kat, just to talk about, particularly in the insurance sector, we're seeing a wealth of reform, including the upcoming conduct licensing regime, or the COFI regime. We've got the insurance contracts bill, which has just come out, the proposed state-backed income insurance scheme, the ongoing Insurance Prudential Supervision Act and Solvency Standards Review, and some of us obviously impacted by the climate-related disclosures. I just wanted to get your take on what you're seeing in terms of the impacts or issues for the insurance industry in this climate.
Thanks, Kristina. Look, I think the main issue for the insurers is just the wealth of reform. And I think you opened earlier sort of saying just, how do you prioritise everything that has to be done in this regulatory tsunami that we have? So impossible to speak to those sort of 6 or 7 topics today. Each of them could probably do with a webinar on their own. But look, just a couple of key thoughts. On COFI, look, it was great to see the Cabinet papers released on Friday, a little bit of certainty that SOP will come through. So we'll tighten that definition of intermediaries down to only those that sell and distribute product, which is a great outcome, and the removal of that requirement that financial institutions will have to manage, train and supervise those intermediaries. So there's some wins for the industry there. Difficulty with COFI, of course, is still we're still waiting for the second reading. The SOP comes after that. And in the meantime, we've got FSLA and full licensing coming down the track, and that interaction between trying to update and put in new distribution arrangements to comply with FSLA, but not knowing exactly what COFI requires from the fair conduct principles and how you put in those effective policies and procedures. So we're seeing a range of approaches there. We've got some clients who are getting really down into the detail and having a go in their distribution agreements, actually defining what is poor conduct, what is misconduct, what is fair. Through to the other end of the spectrum, where basically financial institutions are just requiring that parties to that agreement trying to, all focus on good outcomes. So a real breadth of approach there across the industry. And look, I think the key practical tip there is whichever way you go on updating those distribution agreements, you just need an out to say when the legislation is passed, when we have detail, that both parties will come back and update, amend, progress that as they need be. And provided you have that ability, I don't know that it matters too much which approach you take to your distribution agreements now. Second thing, coming down the line, insurance contracts bill. And look, this is huge, biggest insurance law reform and, since the 1908 Marine Insurance Act. So look, it's massive. And there's lots of issues in there. So it's one, I think, you can't pick and choose which piece of this bill you look at. You're going to have to look at the lot. But I think, the most interesting one there is the duty of disclosure. Clearly, that onus has been turned from the insureds having to tell everything they know to the insurers having to ask. And so insurers are just going to have to think practically, how do you deal with that? What happens to short form underwriting? Are you going to have long application forms? How are you going to manage that? Is it just a premium lift? What are your options? One thing we've been thinking about, and it's in our financial law insight that's gone out into the market, is given that the onus is on the insurers to explain that duty of disclosure, and if they don't, then the proportionate remedies are not available, whether it would be useful to have prescribed wording for that duty of disclosure that all insurers have to use. It's a standardised form. It would then ensure that the insurer has that protection. And look, we're not at all advocating prescribed wording for insurance policies in any other respect. We don't want to end up like we are with investment product. But we just wonder for the duty of disclosure, whether it will be a better consumer outcome if that's explained the same way to all insureds. The other key issue in that bill, I think, is to have a good look at the transition timing. The wording just at the moment isn't particularly clear. Certainly on transition, it will apply to all new policies, but it also talks about applying to all renewals and variations. If that is renewals and variations of existing product, the insurers have a major problem. There is simply no way that the insurance industry will be ready on each renewal and variation of an existing contract to comply with the full wealth of the bill. So have a look at that transition timing wording and make some good submissions there. Final thing, the insurance income scheme. Look, private insurers actually haven't been asked too much to comment on this. And when you read the questions, they're not at all directed to how they'll affect the private insurance industry or advisors, and yet it will have a huge impact. So I guess in terms of prioritising things there from the insurer's perspective, again, timing, the concept that it might be up and running next year is just, it's alarming. Like that, just when we look at FSLAR and COFI, there's just no way we can introduce a whole new scheme and have it up and running next year. Private insurers, is there a place for them in offering this insurance scheme? Does it have to be ACC? Do the private insurers have a place in there? Is there something like the default KiwiSaver scheme that could be used? Could we have default insurance providers for this? And if nothing else, I think private insurers should have a look at chapters 9 and 10 of the long consultation document. This is the section that deals with those who lose jobs because of health or disability. And it talks about the options for retraining, rehabilitation, return to work programs. So private insurers know the importance of getting those things right very early in a claim. And so information from private insurers, because ACC only deals with accidents. So private insurers have a wealth of information to provide on what works in those early stages. And certainly if the private insurers aren't going to be in the market and they pick up the claims post 6 months on, having some input into what that first stage looks like. So those are my key thoughts on three of the issues at the moment, Kristina.
Thanks very much, Kat. I thought I'd pass over to Sam if he had any thoughts on the insurance contracts bill or anything to add to what Kat has just said.
Thanks, Kristina and Kat. Yeah, well, as you say, you could spend a whole webinar on this and probably more. And we did do a webinar last week. But two things to highlight, I think, and very, very briefly, because I'm conscious of time. One, what remedies are going to apply when you get non-disclosure, particularly for life insurers, if you have the 3-year limitation period applying. That's a particular point on which is being consulted. You have a lot of uncertainty around the role of silence in the duty, and also a lot of uncertainty around the unfair contract terms regime and its application to insurance policies. As we know, it doesn't really apply to insurance policies at the moment, but under this new reform, it might well apply to, for example, exclusion clauses, which could be a seismic shift in the industry. And again, we could talk about that forever, but that's probably enough for now.
Yes, I agree. I think on unfair contract terms, I think there was option A and option B, and option A, whilst protecting the consumers, is definitely going to create a huge amount of uncertainty and have a real impact on pricing. I thought I might throw over to Claire just to if you had any thoughts, particularly on COFI, because I think that's another really big piece that's impacting the insurance industry and probably in the wider financial services sector as well.
Well, I suppose just in relation to COFI, just looking through at the sort of the wider financial services industry, I mean, it's definitely creating a bit of uncertainty there. And while it's, applying to banks and insurance and non-bank deposit takers, the wider group is sort of looking to see where this is going to land. There's concerns about, what is the cost if it comes through to my business and I'm a small to medium-sized business, and is there going to be double layouts of regulation, particularly like we've seen through the intermediaries, and that consultation has tried to address some of that. So I think it's probably for that wide industry. It's certainly going to play out. The FMA just said that they're going to release a consultation on conduct, which is going to apply to the whole financial sector. So I think it is still a bit of an education piece, and while it's uncertainty, there is a bit of concern out there.
Okay, and in relation to COFI, given that it's not passing through Parliament as quickly as we would have expected, and as was alluded to previously, we've got financial services firms madly trying to apply for a full FAP licence prior to next March. And with all the juggle of all these consultations in between, do you have any practical tips or advice to regulatory or compliance teams as to what they could be doing now, aside from the distribution agreements that Kat referred to? Is there anything else that firms could be doing now to try and front foot COFI whilst progressing through the full FAP licence application?
Oh, certainly, I think, as with all of it, is looking at their own systems and processes and just trying to add those layers upon layers so that, as you're moving towards the licensing, one, that will make licensing easier, and two, as COFI comes in, I mean, there's a lot of talk about it, but it is something that we should be naturally doing and thinking about in the financial services industry, is that how our conduct relates into the ultimate investor outcome. So it's a matter of just putting in more detail, which I know it's hard on the smaller businesses, but it's just something they just have to keep going with.
Okay, thanks, Claire. And while I have you, I thought I'd direct a question to you around, compliance frameworks more generally. There's been other bits and pieces that have come out that have probably not had as much airtime as the bigger pieces like COFI and insurance contracts bill. Obviously, we've actually had updates to some advertising standards in the past 12 months. Did you have any advice for insurers or wealth managers or whomever's on the call?
Well, it's the continuing theme of this webinar, isn't it? There's a lot going on all fronts, and if you're not dealing with consultations and insurance and complete regulatory change, we've also got a bit of going in the compliance frameworks. And while it may be slightly lower down on the list, it's still just as important as everything else. That new financial advertising code that came in on the 1st of March, and that is just adding more of a modernised definition of financial advertising. And what it's making clear is that it's going into the wider channels. It's definitely picking up social media. It's picking up user-generated content, which is wider, and also any sort of fringe technology services, the crypto, the platforms. So you've got that code sitting off to one side, then as well as what came out last year, which all the members I'm sure would have read, is about the FMA guidance on advertising. So you've got the two kind of, not necessarily inconsistent, but two type of regimes going on. And what I'm sort of seeing in response to it is I'm definitely seeing a tightening up on advertising sign-offs. While some of our larger members will have this well embedded and will just be adding further detail in, I'm also seeing many more mid-sized firms seeking legal input and sign off on their advertising. So these changes to the compliances is actually, you could say it's actually bringing up the whole industry in relation to that space. And I think the code and the guidance, it's actually quite helpful for people who've got compliance departments, And when they've got that tension with the marketing team and the marketing team saying, we want to put this in, and you've got something to point to and say, actually, you can't, or we have to include this, because that's always the ongoing battle. Definitely concerned about reputation and getting it wrong, and the recent enforcement in completely different sectors, by the way, is emphasising that. And I suppose just one other thing I sort of wanted to add is the ongoing use of social media in the wholesale space. I mean, there's really starting to question whether that's the right space for where people can find sophisticated investors, and if the wrong type of investor, what type of harm that's going to create. I know there's a review going on in that sector, and it'll be really interesting to see what the report is around that advertising space of what they can do, because that's just that widening of advertising. The other thing I just wanted to cover, while I'm on the compliance framework, is, and we can't really go without mentioning it, is the sanctions, the Russian Sanctions Act, because anyone who's in a compliance team in AML and CFT must be really, really busy this month with the Sanctions Act coming in. And then last Friday, the regulations came in, which actually listed the types of individuals, entities and classes of people that the sanctions apply to. And so that will be making a huge amount of work going on where, financial institutions and reporting entities will be checking their existing customers, putting processes in for freezing of assets, making sure their onboarding doesn't pick it up, and then also being able to do the suspicious reporting. So it's hard to imagine that an organisation can get that put in place within a matter of weeks, and so it must be being done manually for now while systems and processes are catching up. So you can see all aspects of our members be working in their different divisions while all these changes are going on.
Thanks, Claire. Lloyd, I think you've done a bit of work on the sanctions and AML space. Did you have anything to add to that on the latest Russian sanctions?
It's keeping a lot of folk busy. I think the thing to remember is it's not just New Zealand's regime that you need to think about if you're involved in investments or transactions that go beyond New Zealand. Lots of people also have to keep an eye on what the Aussies are up to, and also European and the US. So it's really complex. My sense is that the government has basically listened to a very limited group of stakeholders. There hasn't been a lot of consultation, so there are lots of fishhooks. But Kristina, I guess I would like to flag something we haven't talked about that I regard as the sleeper in the whole area, which is the climate-related disclosures regime. So we've all just got so much on our plates, and yet in contrast to COFI, which doesn't even have legislation enacted yet, but's getting a lot of airtime, Part 7A of the Financial Markets Conduct Act is in place. The XRB has had its first consultation on governance and risk, and last week put out its consultation on strategy and targets and metrics. So they're on track to do the full consultation on the new climate-related disclosure standard mid this year, so that it will be issued by December and apply to financial years starting in 2023. Of course, the reports won't need to be lodged until the end of that year in 2024. But what we're seeing is in businesses, the people in finance and in the business itself are understanding the pressures this is going to create. But legal and compliance, particularly, I have to say, in the fund managers and the life insurers, are so swamped with other stuff they're not getting to it. And one particular call out is if you've got people who are saying, hey, we want to shed from our investment portfolios things that will look bad when we have to report, it is really important that they've got the underpinnings for the claims that they're going to make in their products. And what I mean by that is you can expect the FMA to look very hard at anything that they conceive of as greenwashing. So watch out for the FMA saying more things on integrated products, which is their rather odd term for financial products that make ESG claims in the next few months.
So does that mean, you talked earlier about when a new regime is put in place, the regulators will tend to take a softly approach of 3 to 4 years. Are you saying that may not necessarily apply in relation to, things like greenwashing and where our investments are and things like that?
I think, so there's two things. Good question, Kristina. I think in terms of the regime itself and the climate-related disclosures that get filed, I think both the XRB and the FMA are signalling that it's better to have a go and do the best you can. But on the other hand, they will say that part 2 of the FMCA about misleading or conduct and particularly unsubstantiated representation, so good things you said might later prove to be true, but you didn't do due diligence at the time, that's been around since 2014, and they're, I don't think, going to cut anyone any slack on claiming that they've shed carbon-heavy investments from their portfolio if they haven't. So more exciting stuff to deal with through the year.
Yeah.
Sorry, Kat.
No, I think on that point, just to, the FMA's guidance on integrated financial products came out in December 2020. So even before their guidance on just general advertising approaches, with a lot of the same messages, substantiation and look at it holistically. So I just agree with Lloyd. I think on the advertising, the promotion of any sort of green products, we can expect the FMA to be of the view that, providers have had enough time and the guidance has been out, for well over a year, which is different to the actual climate reporting. Okay, good tip. Thank you. We're nearing the end of the session, so we should probably open it up to Q&A. Carissa, is there any questions coming in from the audience?
No, and we encourage you to use the chat function, but I'll kick off with the question that I have. We've got a very wide membership ranging from smaller organisations to quite substantially large organisations. Do you think from what each of our leading lawyers are experiencing, there's differences in the types of regulator engagement and the topics that are receiving regulator engagement? Do you think there's a difference or not? I ask because what we see in the media is often a big name that they're almost making an example of, and are those same types of issues being experienced by smaller organisations?
I might quickly respond to that first. At the regulator, they have a process that they call heat mapping, and someone who impacts a lot of customers obviously gets more, is more important to them in many ways because of the number of New Zealanders who would be impacted. Secondly, I think you're right that where they want to send a message to the market, they do look for a big name because it will make people sit up and take notice. So often these things are about the individual organisation, but also sending a message to the market.
But I absolutely agree with you, Lloyd, but then I think you can certainly, areas like AML, they are certainly approaching lots of organisations, sort of big or small, about their processes and compliance programs. So maybe it's what type of enforcement, depending on the size of the organisation as well.
Thanks for that. If there's no questions from the audience, and please use the chat function. It's not often you can ask a lawyer for advice and not have to pay for it. So use the chat function.
Sorry, Kristina, what? Did we agree that?
I'll ask a question of you, Sam, that we didn't, one of my questions actually that we didn't quite get to was in that same IPSA consultation, which is out at the moment on distress management and enforcement, there is a couple of paragraphs on material breach reporting. And I just wanted to get your thoughts on that.
Yeah, I think a couple of paragraphs is exactly the right way to describe it. A couple of paragraphs saying we think we should introduce a material breach reporting regime for insurers. What do you think? So there's not a lot of detail again as to what that regime might involve, what the thresholds should be, to whom it should apply, apart from insurers. But again, I come back to that point I made earlier about part of this consultation is seeking to achieve consistency across the different sectors, or RBNZ's powers across the different sectors. And insurers currently are only required, they only have an obligation at the moment, to proactively report potential breaches around the solvency margin. But if you compare that to the banks, early last year, I think it was, banks started to become required to report material breaches of their conditions of registration. And that was implemented under the Reserve Bank Act. And the Reserve Bank actually publishes material breaches that the banks have reported according to its own criteria. So if we're looking for what this regime, if we're looking at what the RBNZ might be thinking this regime should look like, we can look to the current guidance that it's issued in relation to breach reporting for banks. And there, I think you start to get a sense of where this is going. So if a senior manager has actual knowledge of information that suggests that there has been or will be a material breach, then that is the kind of information that needs to be reported proactively. And there's a point in the guidance to say that banks, under the current regime, should err on the side of caution. And if they're not sure whether or not to disclose, they should disclose. And that puts me in mind of the dreaded Principle 11, which is a principle that the Financial Conduct Authority in England has, a requirement that banks tell the FCA everything that the FCA might want to know about. And that's at about the level of generality it's expressed. And thankfully, the Reserve Bank's guidance is a bit more detailed as to the factors one should take into account when assessing materiality. But I think in the back of your mind, that's a kind of easy way of thinking, a slogan where this might be going. You're going to have to tell the bank if the bank would want to know.
Thanks, Sam. Another question we have had through on a rather large topic that's involving quite a lot of compliance activity across the industry is the CCCFA and what changes have been made. Do we think there's going to be more changes and timeframes around that? Who's involved with CCCFA?
I'm currently working for a client on a CCCFA class action, so I shouldn't say too much about it. But I think this is an act that has been in the news a lot recently, and I think the government is now reviewing further changes to it. So my only point here will be that we are going to need to pay quite close attention to the changes as they come in and hope that there is proper consultation around the externalities of any changes that are made.
I see there's another question in the chat on COFI. So with COFI providing more powers around regulating incentives, particularly those banning incentives to financial advisors based on volume or value, how far do we think the FMA will go on this, i.e. a complete ban? What about those companies that use balance scorecards, which have a small element of commission based on volume and value, whereas there are other measures based on good customer outcomes? Claire, shall I direct that one to you, perhaps? Or Kat, for that matter.
I think that was Claire pointing at me with her.
Sorry.
Yeah, look, it is a little bit difficult because the only detail we have on that ban is that we will now have regulations for it. So during the commission submission process last year on this topic, the feedback on the submissions was that the industry was very keen to not regulate for this and to leave it to principles and guidance from the FMA, but consumer groups were very keen that this was actually prescribed in some form. So the only information we have coming out of that at the moment from Cabinet is that they will introduce regulations that will place the ban on it, but how that is drafted, the extent to what it says, those exact questions around how far does it go? Can you still have some sort of balanced scorecard? We don't know the answers to any of that until we see some draft regulations. It was interesting last week in Samantha Barris's talk, she was specifically asked about the balanced scorecard as well. So it's definitely top of mind. But look, until we get some regulations, we don't know. And I guess our key risk around that is, are we going to have time to consult on those draft regulations, given how far down the COFI timeline they're going to come in? So look, we simply can't answer that question. We don't know what the regs are going to say.
Thanks, Kat. I think we're just about out of time, so I want to thank all of the panellists for your time this morning, and I'll pass over to Carissa.
Thank you, Kristina, and thank you to each of our leading lawyers, Claire, Catriona, Lloyd and Sam. It's the FSC's pleasure to host sessions where our members share their wealth of experience and knowledge and give their valuable time to create these webinars as a resource for our members and guests. And of course, thank you to all those who have attended today. The FSC will continue to host as long as you are keen to come along. So please keep a lookout and register for upcoming FSC sessions. The next scheduled session is a CEO panel discussion, the future of New Zealand's health system, next Tuesday, the 29th of March. In that session, we will hear from Professor Gorman from the University of Auckland, who's been involved in health reforms in a number of jurisdictions and sets the scene with his views on the government's proposed transformation of our health system. He will then be joined by a panel of health insurer CEOs to respond and share their views on the future of our health system and implications for insurers and care providers. As that session and today's session are all recorded along with all FSC Connect webinars, and today's session will be available soon to view again and share on the FSC's YouTube channel. Thank you all and have a safe and productive remainder of your week.